With inflation starting to roll over, the question becomes, what should we expect next? Hey everyone, and welcome back to this week's episode of the Vancouver Life Real Estate Podcast and YouTube channel. Inflation, inflation, inflation. That's largely all we've been hearing now for almost a year. And as the metrics have started to roll over in that aspect, we want to get ahead of what the next question is going to be. And maybe start trying to look at some of those answers. Because if we look back just a few short 6 to 12 months ago, it was all about housing crisis. And now, of course, it's all about inflation. So when inflation gets under control again, what's the next buzzword? What's the next headline here? So as we know, inflation did roll over from the 40-year high last month of 8.1% down to 7.6%. Now, typically bond yields fall on this news, which they did briefly, but they rebounded. So at the time of this recording, they're sitting around 3.2% is the yield, and this is up from 2.57% recorded earlier in August. Now, why is that? Well, what they're looking at here looks to be core inflation. And core inflation differs from inflation simply by essentially stripping away what they call the volatile components. And core inflation actually rose last month. It rose about 0.5%. The Bank of Canada's measures their core. It looks like it hit 5.3%, up from 5.1%. So again, when you've got inflation, coming down, but you've got core going up, it's really going to give credence here to the Bank of Canada likely raising rates again at their next rate hike announcement. That's falling on Wednesday, September the 7th. Widely believed, we're going to see another 0.5 point, but we will not be surprised if we see a 0.75 point hike increase, 0.75%. So look for that. Of course, we will have Mikhail back on the podcast then to go over what is happening with mortgages and whatnot. But again, inflation's rolling over. Core has yet to, but it looks like it probably has likely peaked here in August, and we're going to start to see core inflation coming down when we see the August numbers actually register, and then of course September as well.
It's funny, hey, it just goes to show how, depending on what you want to look at, these basket of goods just kind of get sort of amalgamated that kind of suits the narrative or the need for the rise or whatever it is they're trying to achieve. You know, it definitely gives credence to that hike. But generally speaking, I still think inflation's higher than where it says it is. That being said, let's talk about trigger rates. On our last 100 basis point hike, that pod, we had Mikhail on the pod talking about how the next time that they raise rates, it's going to put some people in precarious positions when it comes to the trigger rates that exist inside their variable rate contracts. So it may result in putting people in some, like I said, precarious positions here. So around 15% of all mortgage debt outstanding, originating from March 2021 to February 2022 at very, very low rates, 1.6% on average. And while these trigger rates, what triggers them varies between lenders and borrowers. If trigger rates actually go up down by 0.5% from their current levels, that could be a very, very scary scenario for some people. They are going to get mandated by the bank if they haven't done anything to mitigate what's happening, right? So there'll likely be more coming at the end of the year, because you got to remember, we're at 2.5% right now, and the target rate is 3.5%. So as this continues to climb, more and more people are going to be subject to this. But by how much? I mean, RBC estimates their variable rate holders will see an increased payment of about $200 on average. But let's keep in mind, floating variable payments are up around $1,200 on average, on an average $1 million home, right? So some significant variables in that variable cost model.
And that obviously is going to affect prices. You can't have interest rates climbing and basically affordability being further eroded because people just can't afford higher payments. And of course, they're not qualifying for higher payments either. So we're going to see prices come down. Nationally, you have likely heard that, prices did drop again here in July, 1.7% according to the HPI, which is a large number, knowing that it's a bit of a lagging indicator. And that followed the 1.9% we saw back in June. HPI across Canada is down 9.9% since the peak. And this is essentially the steepest, the quickest decline in history when we look at the fact that HPI has only been recorded since about 2005. So we're looking at a 2-decade record here at least. And it's significant, and it's not going to stop in the month of August here, we'll tell you that much. For reference here, when we're talking about this being the biggest drop in history, the global financial crisis in 08-09 saw about a 9.2% drop total, peak to valley. We're at 9.9% and still heading downwards. 2017, 2018 was the most recent decline, where peak to trough was about 8% even. So we are seeing much further declines than we saw for both of those eras. The brunt of this is being led by Toronto. So Toronto's HPI is down 13.2%. That is a big chunk, again, from peak to trough, and again, still dropping. You compare that to back home here in Vancouver, where we're down 4.5%. Much softer rate of decline. Now, the actuality is more so than that, or more than that, because we know that both average and median are down between 10 and 15%, and will go down here again in July, or in August rather. So HPI will play catch up to that number, or those numbers. But again, we're not seeing things drop as drastically as we are in Ontario, specifically Toronto and of course their suburbs. But what's also interesting here is the inventory, because nationally we're still sitting at like 3.4 months of inventory. And that's well below our long-term average, which sits at 4.9%. So again, we've been talking about people not really panic selling for a long time, and that's still the case. It is both buyers and sellers sitting on the sidelines right now. Sellers don't need to sell, and they're just going to wait out until they know they can get a better price in a hotter market. And the buyers are doing the opposite. They're thinking things are going to continue to drop to a point that's going to work for them, so they're just waiting for that metric to hit. When we talk about this time months of inventory remaining, we would need about another 40% more inventory than we have today just to hit the average. So that gives you an idea of how low it is. And, we've got September just around the corner, and there's a key number of indicators here that are saying that, look, September market is going to pick up a bit. So when it picks up and it comes into the face of a low inventory marketplace, we know what that can result in. So here we go. Canadian inventory. Yes, here's the funny thing. And again, showing how resilient Vancouver is. Canadian inventory is up 45% from this time last year, but Vancouver inventory is actually lower than it was this time last year. So what does that tell you? Prices are declining at a lower rate than the national average by a lot, and inventory is doing the opposite of the national average. So Vancouver proving resiliency, and a very strong indicator of what to expect on the other side of inflation is a tight market again.
Vancouver's proven its resilience before, right? And you can see why it's doing it again. And it's interesting because actually last weekend, we were involved in a multiple offer, if you can believe it or not. And now I'm not saying that that's par for the course here, but I think as inventory continues to struggle in Vancouver, more buyers are continuing to enter the market. I mean, we just had record levels of immigration. We'll touch on that in a little bit. But as buyers, continue to enter the market and the inventory doesn't continue to climb, you start to get more and more buyers, especially in the very desirable spots or the hot spots in town, when there's restricted inventory. And just like you said, Dan, it's setting it up for an interesting future here. One I've probably seen before. Anyhow, but with that being said, when you speak nationally, let's talk about mortgages too, because payments, as inventory continues to climb and prices continue to fall, payments for your mortgage sit around $1,000 higher, or 47% more than Q3 2021 levels, right? So the cost of borrowing has gone up dramatically, restricting purchasing power. So you're going to have more and more people sit on the market, bringing the prices down. With that said, though, it appears to look as if we've peaked, right? So based on price trends and mortgage rates beginning to fall, required payments are down by about $100 since the peak in last month.
That helps. At least it's, again, feels like it's rolling over, right? We've hit this peak as far as pricing goes, and things have now just begun shifting. So once that trend begins, it typically continues for some time, as cycles do. But let's talk a little bit here about the rental market, because if you've tried to rent something in the last few months here, it is brutal out there. I mean, we're still hearing stories of clients with investment properties that are putting them on the market or flipping over tenants because the last ones chose to leave, and they're getting upwards of 100 plus applicants in a week. We've got property management companies that are attesting to this as well. And people are essentially just throwing money at rentals now. They're bidding wars in rentals right now. It's a very challenging market out there. It's so tough. And there may be some reprieve coming. There may be, because we have 200,000 rental units under construction right now across Canada. This is an all-time high. And for reference, it was only 20,000 being built back in the year 2000. That crept up to about 80,000 in the year 2015. And now we're sitting at 200,000 under construction today. Interestingly, we look to Toronto again, where they just had the highest number of rental built units complete just last month. And it was the first month that rental rates actually lowered in the last 12 months. So again, when inventory is increased, it's going to start to feed into that demand. So again, expect to see more of these rental properties coming on market this year. Again, it is a national number, but you're going to see it here as well as in Toronto for sure. And ideally, those rental rates start to peak off a little bit.
Yeah, and I think, well, for a period of time, because if we touch on immigration, there's going to be more pressure coming, right? So, let's talk about housing starts as well. So those two things are very important to help with the balance of inventory and demand cycles. But when we are actually down in housing starts from the peak of about 290,000, but still at an impressive 260,000 housing starts. And that's currently under construction, and that's for all property types, and that is an all-time high. So when you look at rentals plus units being built, that's a combined 320,000 units being built you can buy. So the question is, will that actually be enough to offset the record 230,000 permanent residents that we've seen in Canada in the last 6 months, plus the future immigration that's coming in, plus 200,000 study permits, plus 170,000 odd Ukrainians? There's a lot of people coming here right now and a lot of pressure on the rental housing market. And it's probably not going to stop, right? So Canada's got a very, very aggressive immigration target. Looks like they're going to exceed it by some margin this year too.
It's great to see them hit a goal. I know that they can. That has nothing to do with immigration. That's just about the government kind of showing that they do have the power to hit certain metrics if they want to. Okay, so let's talk mortgages again for a sec here. Historically, being the last 12 months, mortgages, of course, have been most attractive on the variable side because people want to pay as little as possible when they're paying for their home. So for the first time in these 12 months, new mortgages have actually shifted in popularity from variable into fixed again. So variable rate mortgages are now constituting less than 50% of all new mortgages issued. And overall, yeah, of course, those people are getting less mortgages because less homes are being purchased right now. Mortgage growth dipped below 10% for the first time in 18 months. So that understandably will continue for the foreseeable future, likely till at least the end of this year. We are going to see things pick up, I believe, in fall, but the trend is going to be nowhere near what it was, of course, for the last 18, 24 months.
Yeah, and I think that also points down to consumer sentiment at the end of the day. A lot less people are buying a lot less places because people don't have the money to buy it. There's all kinds of reasons, but we're down across the board, right? So in terms of consumer confidence, July points to a 5-year low in spending, down 2%. And employment dropped predominantly in the retail sector last month. So showing you that the demand for buying items and anything retail is dropping. People are conserving their cash. They're stepping away from, things like risk-on assets and also buying cars, clothes, and anything to that effect. I mean, when you've got, the price of bread up 15%, puts your priorities in check. And if we look to consumer confidence and how this compares now to the last sort of lows, it's the lowest since the lockdown, anyhow, was 2009, right? So anyhow, I mean, all of this points to consumer behavior, and if that is stepping away from spending, then it's actually good news for inflation. So keep an eye on that in the upcoming months.
Yeah, it's essentially the opposite of the wealth effect, or it's the wealth effect having a adverse reaction. When people feel rich, they're going to spend more, and when they do not spend more. So this is kind of what we're seeing there. You definitely feel it on the ground, and you definitely feel it in real estate right now. So let's talk briefly here on employment. It's still very similar to what it was last month. There's essentially 1 million job vacancies here in Canada. You wonder why immigration is so hot. Listen, on a global scale, if you hear that there are a ton of jobs available in a country that is very open-armed and very easy to get into, it's going to attract people. That's just the nature. And the thing is, too, these aren't just minimum wage jobs. In fact, the number here for businesses reporting a shortage of skilled labor is up now all the way to 56% of these companies. And yeah, that's an all-time high. There's never been more demand for skilled labor in Canada than today, right now. It's been growing too. It's not like this has just happened overnight. So you look all the way back to 2010, which is where the current data that we have is for. It was 25%. Wow. 1 in 4 businesses in 2010, 12 short years ago, said they had a shortage of skilled labor. And that has literally doubled, more than double in 12 years, up to 56%.
Wow. That's incredible. And actually we can speak to that. We're working with a client right now who's looking at buying a commercial asset, and they are actually wanting to stay more local because even a 45-minute drive out too far, they can no longer find the skilled workers that they need to do the jobs, right? So, we talk about people competing in certain areas for different reasons, and inventory remaining where it is. When you've got problems like this where you're struggling to expand because the labor shortages are so tight, it puts existential forces on micro markets. And I think that's partly why Vancouver has done not nearly as bad as the rest of the country. Let's speak a little bit. We
also had a team member here too, right? They talked about their parents having a $20 million contract in front of them that they can't even accept because they can't find the workers to help fulfill the project needs.
That's right. Yeah.
So this is, if we have immediate stories, this is, as widespread as the data is telling us.
And that's 20 million worth of work, Dan, that needs to get done before the winter. Right.
That's right.
So anyhow, let's talk about insolvencies. They are up 20% year over year, led by a 31% increase in proposals, the restructuring of unsecured debt. We are still 36% below pre-pandemic levels, so still quite clean in that respect. credit card insolvencies ticked up for the first time since the lockdowns. So that does not surprise me when you've got inflation running at where it is. Definitely starting to hear of stories of Canadians struggling to pay for those things, right? So credit card insolvencies are likely going to rise as these interest rates and inflation continues to pump.
Yep, there it is. So inflation, it's been running hot for over a year now. It'll likely take an equal amount of time to get back into the 2 to 3% control range that they are targeting. But what happens on the other side of that? Again, once inflation becomes old news, aka once it's under control and housing becomes the topic again, as it always seems to do here, especially in Vancouver, what's going to be the underlying story? What's the sentiment? It's going to be, I think, very similar to what we've been dealing with for the last 20 years, 15 years, 10 years. It's going to be a shortage of inventory, and it's going to be an uptick in prices. And no, it's not going to be like it was the last 2 years, and nobody wants it to be like that, really, because that was unhealthy and unsustainable. But again, you can't create a dynamic where you've got a supply and demand issue and not see prices tick up again. So again, I'm not saying that's happening tomorrow, but you can't forget about the issues that we had just 12 months ago, because they still exist. Yeah. They really do.
They haven't gone away. I mean, record levels of, immigration, record levels of low unemployment. The demand to live in Canada is still, globally speaking, very high. Huge amount of interest from foreign students. The list goes on. There's a lot of reasons to be here, and especially in Vancouver, that has its own geographical constraints. I foresee this as short-term pain and then more long-term pain, I guess, depending what side you're on.
All right, so we would love to hear your comments. What do you think it's going to take for inflation to get under control, and how long is it going to take? And do you believe that there's going to be a housing shortage on the other end of that? Thanks as always for watching and listening. We'll see you next week.